Welcome to the What to Watch video update. This is the last video that I do each weekend where I pick out those things that seem to be talking to us right now and we really need to pay attention to. And I come up with a positive list, a negative list, and then those things that we're just watching to see how they react to market conditions and then see if they suggest we're turning more positive or turning more negative. This is being prepared for Tuesday, January 21st. The first thing that we'll look at are a series of positive charts. Now, we turn back more positive. We are improving right now with the market. We were turning more negative. We're not full-blown positive yet. We still are getting some mixed signals, but even those mixed signals are showing some improvement right now. But as always, there's things to be concerned about that we want to keep an eye on. I don't believe in just using two or three indicators and coming to a 5-minute conclusion. I look at all the evidence that I can, and then I put it together and I reach what is called a consensus approach. And if you want to find out what that is, I post videos every day. I also have a program that you're welcome to take part in and check it out and see what you think of that. So let's go in and look at some positive things right now. The first thing is the intraday chart, and this is what I follow during the day. Sometimes I'll bring up multiple charts at the same time, mainly looking at end of day versions of, okay, if we closed right now, what would the result be? But this is what I follow most of the time. Each one of these bars are 10 minutes. If it's green, that's up for that 10 minutes. If it's red, it's down. And we go back to Monday where we did gap lower, and then we spent the rest of the day coming back up. Now, I was looking at getting into some bearish positions here that would profit from the market going down. But when I saw the intraday pattern here, I'm like, no, 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 no. This is strength coming back into the market, even though we closed down for that day. But we opened a lot lower. We set the low right at the open and we closed right at the high intraday. So I'm like, okay, let's just hold off looking at the bearish side of things. And this is one of the advantages that you get by watching an intraday chart. And there are lots of free charts out there. There's one at investing.com that you can follow. Now, it's a 15-minute bar chart. I prefer 10-minute, but hey, it's free. So if you're a stockcharts.com member, that's where I get all my charts from. Excuse me, you can bring up one of these charts as well. And you can do this for stocks. It doesn't have to be just for the S&P 500. But we were starting to say, okay, things are looking a bit better. There's some other indicators that we follow that I'll go through that we're showing an improvement. And you combine that with the positive looking intraday action, and that was pretty good. Then we gapped higher on Tuesday. We came down. We did set up a support level. This dark blue line here is called the daily pivot. And then we started to go up, and it's like, okay, maybe we can continue going up from here, but either it started too early or something, but it just kind of fizzled out. And then we ended up closing back down around the daily pivot again, a little bit off of that. Then we started to see things looking a little bit better. CPI came out on Wednesday and it went up, but it wasn't up as much as the market thought it was going to go up. And so the stock futures went up before the market opened. We gapped higher and then we closed just a little bit off of the high in Wednesday's session. So things started to shift. Now, Thursday was pretty much a non-event. We had PPI come out that day, or was it CPI? If I forget the two. One of these was PPI, one of these was CPI. Maybe this was Tuesday. And then we just kind of chopped along sideways. There was really no conviction. Now on Friday, things are looking pretty good in Europe. We have Germany setting all-time highs, and that fed over into the US market, into the futures, which then led to the gap higher in Friday's session. Now we're a little bit concerned about this, and I'll show you when we look at the daily charts, but we were able to get up above R2. We actually hit R3, which is right around the 6,000 level. So this is another hurdle that we'll be watching. Can the S&P 500 get back above 6,000 if we continue to go up? And then we closed just a little bit under 6,000. We actually went above 6,000 for a little while. All right, another thing that we're watching that right now is looking a little bit more positive. This is a basic chart pattern. I don't use wedges or all these different lines that you draw on the chart. I've seen them fail as much as I've seen them succeed. That's not good enough for me. But sometimes just looking at the bars themselves can give us some insight. And there's a line on here. That's the closing value. That's a line chart. And then there's a bar chart on here as well, the open, high, low, close. And we've been concerned about this because we set our high back in December, and then we started setting a series of lower highs. We came down, we set a low, we tried to come back, another lower high, another just barely lower low here, a lower high, a lower low. Well, we were able to break above this trend line. Now, I put this trend line on here. There's nothing magical about it. You could adjust this and still make it look at more so it's more negative. You could draw it a little bit different and make it look even more positive. But I just put this on here as kind of a reference. If we can stay above this, now the next step would be, can we get back to this previous high? If so, that would make things look a little bit better. If we can get back up to this other previous high, that would be even better still. And if we can get back up into this area, we have a shot possibly at setting a new all-time high with the S&P. This is a series of lower highs and lower lows, and that just shows that the market is a bit vulnerable. We're still seeing that with the QQQs, which is the ETF for the NASDAQ 100, and I'll show you that later. But for right now, we're a little bit above this line. We went above it intraday, and we're at least improving. We'll have to see if we drop down from here, that could take on more of a negative slant again. Then this is just a trend line going back to the October 2023 low. Here's was the low that we set over the summer. This was the day that the world was falling apart. That lasted a day and a half or so. And we came down to this trend line. And so far, we've been able to bounce up off of that. So that's positive. This trend line is still holding. We're turning more positive with sentiment. Now, we're still getting a very low reading. We just about made it down to 25. But we look at the context of this. We're going up. And so that's an improvement. Now, it would turn more positive if we get above 50, and then we just keep going up from there. So the reason why this is on the positive side is that we are seeing an improvement. In fact, a lot of this came in Friday's session, which was also options expiration, and that can be its own crazy kind of day anyway. All right, we are coming down with the VIX. Now, this is still giving us very high readings, so we're concerned about this, but we're below 20, both with the line chart, that's the closing value, and the bar chart. And we're starting to drop below these moving averages that just kind of mark the midpoint of the current VIX range. So if this continues to fall, that would still be more positive for stocks. We're seeing the momentum of the VIX going from up as measured by the MACD. Now it's starting to come down. That's also more positive for stocks, at least for the S&P. And we're below 20. And when we're below 20, this is when we start to see positive annualized returns. This is research done over a year ago by Tom Bowley, who's connected to stockcharts.com and earningsbeats.com. And the fact that we're below 20, that's positive in and of itself. But the further we go down with the VIX, the better these annualized returns end up being. As this goes down, that just means fear is coming out of the market and people are turning more positive. But then we get to the point where people are so positive that we start using this as a contrarian indicator. We're still looking pretty good here when we look at an intraday chart of large cap growth. That's in blue versus large cap value, which is in red. Now, value had a pretty good day on Friday and a pretty good week, but we're still seeing the blue line above the red line, even though these are on different scales. We like when the blue line is on top. And we're also holding up fairly well here with the S&P growth to value ratio on a 10-minute intraday chart. We started to come up at the end of November, and then we've been going up really nicely. We've leveled off, and we aren't really breaking to the upside. But even while the market was under pressure, this ratio has been holding up fairly well. This is an end of day chart looking at growth of value for the S&P. Still in an uptrend, went up in Friday's session, not breaking out above this previous high, but still looking pretty solid here. And we compare a growth ETF with a value ETF. Now, this has been showing some weakness lately. We're coming a little bit further down into the rainbow. We did tick up a bit on Friday. It will be even more positive if we go up with this ratio and actually get above the rainbow again. It was really strong at the end of November going into December. And this was when we set the all-time high with the S&P. And this has still stayed on pretty strong, even with the market setting a series of lower highs and lower lows. We want this to come back and show some more strength. Discretionary to staples still looking pretty strong. That's the bottom area of this chart. Staples have been under pressure. Discretionary has been doing quite well. This was the end of the world day last August, and this has been the strongest performing sector since last summer, and it's still doing well and outperforming staples. Discretionary is more growth oriented, where staples are more defensive, and we want this to go up if we're more positive on the market. And we look at small cap growth to value. This has still been holding up, even though the index has been going sideways. Are we starting to possibly break out now? We don't know. We've been faked out before. So under the surface, though, the growth to value ratio is still looking pretty solid. And we're seeing pretty much that same thing with the mid caps. They look like they're improving here, even though we closed well off of the high in Friday's session. But is this going to see some follow through upward action with the index itself? The growth to value ratio is holding up for the most part. We have the Qs to S&P coming back up to the moving average, but we're concerned because the moving average is starting to go down. So that's a little bit of a concern there. Discretionary to S&P a little bit above the moving average, and the moving average is flat to slightly going up. Little bit of a concern here when we compare large cap growth to large cap value. We're still under the moving average, and the moving average is starting to come down. But taken together, this has held up pretty well as the market has been under pressure. And we look at the large caps underneath the moving average. The mid caps are at the moving average, and we're a little bit above the moving average with the small caps. So this is still holding up. We lost the 50-day moving average with the large cap growth ETF. Well, we were able to get that back this week. So that's gone from looking negative back over to positive now. The advanced decline line based on price and volume is improving. We're going back up. And longer term, we're still positive because we're above these advancing moving averages. And the 10-day advancers minus decliners, this is crossed back above zero this past week. We're starting to get above 100, which could suggest good solid momentum. Now, when we get a really, really high reading, that may mean that the market is getting exhausted. But for right now, this is still looking quite positive. We're seeing an improvement with the new highs minus the new lows. And we were getting a little bit concerned. We were seeing a lot more red than green here earlier. Now we're seeing the green start to advance and the red start to retract. And so we're going back up with our 5-day and our 10-day measurements here. So this is improving. Now, this was actually looking positive a week ago, even though the market hadn't started going up yet. This is one of 3 smart money indicators that I look at. This is called accumulation distribution, and I can't see this chart until after the market closes. It uses closing values to update every day. I can't watch it intraday like I do with other charts. But we were coming above the moving average, and this was actually going up even as the S&P was still going down. It went up on that big down day that we had on Friday, and then we had a down day on Monday, but we were looking better intraday that I pointed out earlier. This was still going up. Now, we're a little bit concerned here because this has been coming down as the market's been going up. We want to see this turn and go back up and at least stay above this moving average. It's still above it. It's really hard to see, but we did tick up a little bit in Friday's session. So for right now, this is still positive. Then our advanced decline ratios, short term, the blue line, intermediate term, the red line, they're both crossing back above zero. We came down to the 200-day moving average with the NYSE advanced decline line, and that is bouncing up. And that's kind of the takeaway from this chart. I know this is not a strict comparison. It's because we're using the S&P, comparing it to the NYSE. It's like the S&P is a broad market index, but not as broad as the NYSE. So we just want to see how are these two performing with each other. But I'm seeing where we came down to the 200-day moving average. Can we get above the 50-day moving average? But longer term, we're still in an uptrend with the NYSE advanced decline line. And these moving averages are calculated on the NYSE advanced decline line, not on the S&P 500. Then we look at the weighted version of the S&P, that's the bar chart, and then the equal weighted version of the S&P, and we are seeing an improvement. The red line is starting to come back up, and that's what we saw. The mega caps had been doing better. Well, they kind of slowed down a little bit this past week, and now some of the rest of the stocks are starting to show an improvement, and that's what we're seeing in this chart. We're seeing the condition of the short-term trend as measured by 20 periods improve. We got above the blue line and the green line, and now we're starting to turn back up. And we were able to get back above the 20 period simple and exponential moving averages. This turned the short-term trend back to positive. If the blue line, which is an exponential version and then it moves faster, it's trying to cross above the red line. If that can continue, that would suggest more short-term positive momentum. These are the stocks inside of the S&P 500 that are above their 20-period moving averages. We crossed back above 50 and we're looking pretty solid here. And then we have a study that was developed by Art Hill. We crossed above 70. Now, this is looking pretty positive short term because if you go back, especially when we had that downturn last spring, we came down and set a really low level. And then within a pretty short period of time, we crossed above 70. And you can see what the S&P did after that. Now, it doesn't mean we're going to go straight up. We had some backing and filling along the way. But this is looking pretty positive too because we came down in December, excuse me, and we dropped below 10. And then we tried to bounce up out of that. We came down, set a low, but this is a higher low. And then we went up, came back down, set an even higher low. So this is looking more healthy right now. And now we've been able to go above 70. That's good short-term positive momentum. Can we continue to see this? Because the other time when this happened, we see really good reaction going further out into the intermediate and even long term. All right, then here's another type of study. It's based on the open, high, low, and close. It's a 20-period simple moving average. It creates its own little mini rainbow that I call it. We were able to get back above that because you can see this green line here. This was acting as overhead resistance, which kind of is equated to the 50-day moving average. This is based on 20-period moving averages here. Now, what we're going to need to see going forward is can we stay above this mini rainbow? The longer we stay above it, these lines will start to turn and go back up. They're still going down, so we're still a little bit vulnerable here, but the fact that we're above the rainbow is positive. Then we're keeping an eye on the 50-period moving average. We lost that. We actually started to drop below it. And you can see here, a number of days, this acted as over, at least 2 days, it acted as overhead resistance. We could not get above the red line, which is the simple 50-period moving average. Well, in Friday's session, we were able to get above that. Then this was providing support as well. The 100-period moving averages, I stopped showing this in the daily chart, but we were really focused on this about a week ago. We actually came down. Now we dropped below the 100-day moving average intraday, but 3 days in a row, we closed above it. That set up a good level of support, and now we've been bouncing up off of that. And then here are a bunch of moving averages plotted together. The reason we turned positive in the short term before the intermediate term is because the 20 periods are coming down into the 50s, and we crossed back above those first before we got above the 50. Now, if we stay above these lines will turn back up and they'll start to smooth out again. And this is a long-term rainbow going from 10 periods up to 50 periods. We're back up at the top end of the rainbow again. And intermediate term, we're also coming back up out of the rainbow with these lines not really rolling over. So not a lot of damage was done on an intermediate term basis. Long term also came into the rainbow, but now we're back above the rainbow. So the longer term trend is starting to show more strength again. The S&P McClellan oscillator, it crossed back above zero. That turned it positive. And we're getting up to kind of a high reading. Now, sometimes this can mark a top. We could still go a little bit higher than this. But you can see that when we were coming down in December, we were setting a series of higher lows along the way. So there was some improvement there. But this is getting a little extreme positive, but it's still positive for right now. When the McClellan oscillator is positive, that turns the summation index up, and we're starting to go up based on price and volume. Now, longer term, we're seeing negative divergences here, where the S&P was going up and we're making lower highs based on price and volume. And that's in the back of our mind. But what we focus on now is more the shorter term. Are these lines going up or are they going down? They're back to going up. That's positive. The Swenlin trading oscillator. There was a couple of days where we were getting mixed signals. We were going up based on price, down based on volume. Now they're more in line with each other. We're above zero and advancing based on price and volume. So this is positive. We're trying to turn more positive based on momentum. We're not quite there yet with the PMO. This is the price momentum oscillator. But with this indicator, we can break it out based on price and volume. We've already turned positive when you look at these separately. So that's why it's on the positive side. And then there's a series of studies that go with the PMO With the PMOs inside of the S&P, are they rising? Yeah, in fact, we're starting to get a little extreme here. So it might suggest maybe we've overdone it. But for right now, it's being treated as positive. The buy signals continue to go up, and we're going up to slightly flattening out here with the PMOs that are above zero. So this is showing an improvement as well. Momentum in the short and intermediate term is starting to cross over positive. We're not quite there yet with the PMO, but the PPO and the MACD, I have three intermediate term momentum oscillators. They're looking better. The short term are turning back to positive. We're turning up, but still negative with our longer term oscillators. And the Copic curve, another momentum oscillator, crossed back above this moving average. So that's switched over to positive. The Pring bottom fisher, which seems to have given us a pretty good signal here. When the black line crosses above the red line, that's the signal. And that was just a few trading days before we actually bottomed. And this has been looking pretty solid for the time being. The bullish percent index, this is not a moving average. This is not an oscillator. This is designed around point and figure buy or sell signals. And this is improving. We're above the moving average here. Now it would turn even more positive if we can get back above 50. And we did switch over to positive with the parabolic SCR. This is another one of the primary indicators that I use. It's not ambiguous at all. It's either positive or negative. There's no in between. And we saw enough of an upward move in Friday's session to put the dot below where we had been seeing the dots above. Now, I'll show you later, but the weekly chart is still negative. All right, and then we're looking at the cumulative advanced decline line for the S&P based on price, improving, as well as volume. And we're still going down for the most part when we do a staples to S&P ratio. We want this to keep going down. That means the S&P is outperforming. Staples are more defensive. When that's going up, that means the market could be getting ready to go down. Since we're seeing this going down as this ratio, that's actually positive for the S&P. Longer term, we're above this long-term trend line on this weekly chart going back to the 1987 crash. And now we look at the broader market, the NYSE cumulative advanced decline line coming back above the moving average, improving with our regular NYSE advanced decline line, but we haven't come above the moving average yet, and the moving average is slightly declining right now. We want this to get above this and see the moving average turn back up. We look at just common stock. We're seeing an improvement based on price and volume here as well. And this is another internal measure for the NYSE. The new highs minus the new lows. We're crossing back above zero, where we had been dropping below zero there for a while. So this is showing more internal improvement. Then we look at the McClellan oscillator for the NYSE. I know I have the S&P up on top. I'm just trying to compare the two. This is not extreme, but it did cross above zero and it's now positive. So when this is positive, the summation index based on price and volume, you can see they're both starting to turn up. That's suggesting more broad market improvement. And we are improving with the NYSE bullish percent index, but we're not back above 50 yet. And the NASDAQ 100 bullish percent index did cross back above 50. So that's actually turning more positive. We lost the 50-period moving average with the Wilshire 5000, a broad market measure that we use. Well, we were able to get that back on Friday. And then another broad market measure is the total U.S. stock ETF. We lost the 50-day moving average. We regained that in Friday's session. The NASDAQ, it did fall below its 50-day moving average, but it found some support at this S1 level. It's back above its 50-day moving average, and it closed above this pivot point. These pivot points on a daily chart are good for the whole month. And when we're above the pivot point, the bias is positive. If we're below the pivot point, the bias is negative. This is turning the NASDAQ back more positive. And the NASDAQ actually held up better than the S&P did while we were seeing this downturn. NASDAQ 100 also got above its 50-day moving average after coming down to this S1 support level. And I update these every day on the YouTube community tab. And I update them for the S&P. I go over these every day in the daily videos that I do. So you can get an update of these. But we also closed above this pivot point. So that's looking a little more positive there. We were falling below the 50-period moving average with the triple Qs, which is the ETF for the NASDAQ 100. We got back above that, and now we're getting back above the 20-period moving average. Now, this is a little bit of a concern, and I'll show you this again. We're still seeing a series of lower highs and lower lows with the QQQs. We haven't broke this trend with any real conviction yet, so the market is still looking a bit vulnerable right now. The mid caps were able to recapture their 50-day moving average. So that's why it's on the positive side. The financial sector got above its 50-day moving average. It had fallen below. We had banks reporting earnings this week, and they're a big part of the financial sector, and the earnings were positive. And so that's why we're seeing an improvement here. The FANG index, these are the mega caps, the really big stocks. We never did lose the 50-day moving average here. They held up better as we were going down, and now we're starting to come back up from the 50-day moving average. We held up above this longer term trend line for right now. If we continue to go up, we'll be watching this shorter term trend line for the FANG index. And we're still looking pretty good here when you do a ratio of the S&P 500 to 3 to 7 year bonds. This means that the market is still anticipating a soft landing, meaning that we're not going to go into a recession. And then we look at a broad market measure with short-term bonds, also improving, coming up out of the rainbow. Another broad market measure, but going out to 3 to 7 year bonds, also coming back up out of the rainbow. The tech sector, not quite out of the rainbow yet, but it is starting to turn back up. We want this to continue to go up to show even more improvement when we compare it to 3 to 7 year bonds. The Qs to 3 to 7 year bonds also coming up into the high end of the rainbow, but we want it to break above that. The weekly chart of the NASDAQ 100 going back to 2009, still looking solid. We're still above this long-term trend line. The ratio between the NASDAQ 100, which is growth, and Dow, which is considered to be value, still above this red line. And it's even higher than it was back in the dot-com boom and bust. And you had a lot of perma bears that thought when we came back up here, everything was just going to fall down and go into the earth. Nope, this ratio has actually been holding up quite well. And we look at the Qs, again, the NASDAQ 100 to small caps, also above this blue line, and that's more positive for the market. We need interest rates to keep going down. Now, they went up a little bit on Friday, but we've been really going up with the 10-year yield. We got up around this 4.8% level, and now they're starting to come down. If they continue to fall, which is kind of what they're doing right now, that's why this is on the positive side. That would be more positive for stocks. We're seeing a pretty strong correlation now between if interest rates go up, stocks go down. If interest rates go down, stocks go up. And this is a daily chart where we had been coming down last summer in anticipation of the Fed cutting rates. The Fed came in, cut rates, and then interest rates started to go back up. Then when we were coming back down in early December, this is when the S&P did really well and set an all-time high. Now interest rates have been going back up. If they continue to fall, now they went up on Friday, but if they can resume more of a downtrend here, that would be more positive for stocks. And the total bond ETF, I've been also talking about this in the daily videos. We dropped below the 200-day moving average, but we're now trying to get that back. And this is bonds based on price. We want this to go up. That means interest rates are going down. Semiconductors, still looking pretty solid here, but we're range bound. We come down to the 200-day moving average and then get a little bit above the 50-day moving average. We want this to break out, not just chop around where it's at. It was really going solid in earlier 2024. It hit its high over the summer and has really been languishing ever since then. And then this is pointing out, this is the same chart, but just the closing value, pointing out something of a concern. You see where we set a high here, another high here, another high here. This is acting as more intermediate term overhead resistance. We're coming back up. But if we even hit this level, are we going to hit it again and then come back down? Or are we going to break out to the upside and negate this overhead resistance that we've been seeing with the semiconductors? The Dow Jones Semiconductor Index also was able to get back above its 50-day moving average. It's still in a longer-term uptrend. But then we look at the SOX index. This is just one of the indexes that cover semiconductors. It's in a downtrend, but it was able to get back above its 50 and 200-day moving averages. Also pretty much range bound since last summer. If we can really break to the upside, that would eventually give us a golden cross here. So we're seeing a negative trend on this chart, but the other semiconductor charts that we look at are still in uptrends. And then we look at a ratio between the semiconductor and the tech sector. When this was really going up earlier in 2024, that's when the market was pretty solid. Then we started to come down. Now, it's not that the market went down. It's just that value and other stocks were starting to catch up. And that's why we were setting all-time highs through the fall and into late fall. We want this to go back up to be more positive. We spent a lot of time just chopping around here. It looks like maybe it's improving. Nope, it's getting worse. Maybe it's improving. No, it's getting worse. We are starting to go back up now. If this could turn to a more convicted and longer term uptrend, that would be more positive. The when the S&P does really well, and the Nasdaq 100 for that matter, it's when the semiconductors are leading tech, but both are doing really well because there's all those stocks are in the Nasdaq 100 and they're also in the S&P 500. Now the negative side. All right. We are still negative with our trend. We're just barely starting to cross over here, but we're below the moving average. So this suggests a weakening trend. It hasn't quite switched over to a positive trend yet. This is a short-term ADX. And we're seeing that same thing, even though it's trying to get above the red line here. Now, if you really look at this, you'll notice that the green value is a little bit higher than the red value. The reason this is on the negative side is because we're below the moving average. This suggests a weakening trend. And if we drop below 20, that means we're going to be in a non-trending environment. So that's why I put them on this part of the video. And a week ago, we were talking about, look at this chicken money flow. It's going up even while the S&P is going down. Now we're seeing just the opposite. It's going down as the S&P has been going up. Now, the reason why it's on the negative part is we're actually dropping below zero. Now, the red line is flattening out. It actually hasn't actually turned over negative at least yet. We're going to be watching for that. Another smart money indicator. If you remember back, the accumulation distribution, that's a smart money indicator. This is smart money indicator number 2, which is looking a little more negative, and this is smart money indicator number 3. I use 3 of them. This is the Chaikin oscillator. It's turning down and starting to cross below its moving average, even though it's still above zero. So 2 of our 3 smart money indicators are now showing us some weakness. So this is a little cause for concern. The vortex, we see the red line coming down, but the green line's also going down. When the red line's on top, that means this is negative. And the condition of the 50-period moving average, as measured by a double and triple exponential moving average, we're improving. We're coming back up to the blue line here, but we haven't closed above it yet. We need to get above this and then see the lines not only flatten out like they are now, but start to turn back up. And then if it really turns positive, we'll see the red line go back above the blue line. We're not really seeing that yet. This is another concern. These are point and figure charts here where it measures how much we go up or down with time being irrelevant. It could take an hour or it could take a year. Well, we did see a new X drawn in here. That's positive. But you see, we're getting 1X, 2X, 3X's, 4X's. This is suggesting, are we hitting something kind of negative here? It's right around the 6,000 level. And if we can't seem to break above this and stay above this for any length of time, it's being picked up as something negative, like a trap, a bear trap here. We need to be able to get above this and have some new green X's drawn in. Also, those stocks above their 50-period moving average inside of the S&P, it's improving, but still below 50, so it's negative. Those stocks above their 100-period moving averages, improving, but still below 50. And we are improving. I wanted to keep these charts together. But if you notice in Friday's session, we had a solid up day. We were flat with the 200-period moving average study here. That didn't move. Now, this never did turn negative. It never dropped below 50, and it has been improving lately. But to see the strong up day that we had, we were up 1% with the S&P, and this to not even change, it's like, that's interesting. Just something to be aware of. Then the 10-day average of the highs and the lows for the S&P, we are improving, but we're still below 50. The 50-period new highs, new lows for the S&P is continuing to go down. We need that to turn and go back up. And we're coming up out of the cloud with the Ichimoku study here, but the red line's still above the blue line. It'll be more positive if the blue line crosses back above the red line. We are going up with the green line, so that's short term and that's more positive, but we need to stay above the cloud and see the blue line go back above the red line again. And the trend channel, going back to 2009, we hit the upper end of this, and that's when we set the high. We need to get back and try to break above this again. This is providing some long-term overhead resistance. And we are improving with the advanced decline line. In fact, we're already going above the moving average slightly with the S&P and the mid caps, but we're still coming up to the moving average with the NYSE common stocks, and we're still below the moving average with the small caps. When this will turn to positive is when all of these indexes are above the moving average and then the moving average starts to go back up. This is one of the dangerous signs. This is the weekly chart of the QQQs. I also showed you a daily chart showing a series of lower highs and lower lows. We're also seeing that on a weekly basis. This is longer term, where here's the lower highs, here's the lower lows. Even though we had an up week, we did set a lower low earlier on in the week. We're seeing the same pattern on the daily charts for the Qs and the weekly chart here for the Qs, which is the NASDAQ 100. Now we are possibly looking better with the S&P 500 that I showed earlier on, but this hasn't really broken out and started to improve yet. We just want to be aware of this. Then the momentum for the NASDAQ 100 is improving, but it's still negative. The Dow had a good week, but it has not closed above its 50-day moving average. Small caps had a good week also. They're right at this pivot point now. They couldn't break out above that, and they're still below their 50-day moving average. And then we look at the Russell 2000 small caps. I look at two different small cap indexes. This came all the way down to its 200-day moving average, and we bounced off of that. That was positive, and that was support. But we have not been able to get back up to the 50-day moving average. But the RSI is crossing back above 50, and the momentum is turning back to positive. But when you compare this, the small caps to the S&P, we're still underperforming and it has a lot of work to do. We need to get above both of these lines, stay above them, see a golden cross here. And we've seen a few false signals along the way, but it just hasn't kicked into gear yet. The bank ETF. Now, the financial sector, it's looking pretty good. It's been able to get back above its 50-day moving average, but the bank ETF has not. And so until we can close above this, this is still being treated as negative. Home construction, and then we do a ratio with 3 to 7 year bonds, had really fallen under this long-term support, which is a 250-day moving average. We are improving here, but this is still negative. We haven't even come back up to that 250-day moving average. Now, if we do continue to improve, what was once support, is this now going to become resistance? So we'll be watching that. And then the broad market measure, where we look at the Amex, the NASDAQ, and NYSE, and then a 5 period moving average of the highs and lows, improving, but still below zero. The ratio between semiconductors, which is growth, and the Dow, which is considered to be value, even though NVIDIA is part of the Dow now, not really showing any strength. It's not falling apart either, but we want to see this ratio going up to be more positive. The weekly chart, which I said earlier, the daily chart is now switched over to positive after Friday. The weekly parabolic SAR is still negative since the dots are on top. Then those areas that I'm watching, I'm kind of just not really positive or negative. They're just things to watch. We did come back up with the weekly jobless claims, but the moving average is still going down. And we did come down with the continuing claims and the moving average is going down. That's longer term, more positive. That means that the employment situation is holding up better. And just keeping an eye on volume. We've finally picked up and we tend to be above average with volume most days. The skew index, and I've tried to interpret what this means. We'll see if there's any change since Friday was options expiration. This is calculated using options, so we'll see if this is going to change this. But we're up in a red area where the market is still expecting some kind of a big move. We have a big down move, and I think, okay, maybe I'm figuring out what this is trying to tell us, and then it's wrong. And then we have a big, so I'm just like, okay, something's going to happen here according to the market. Whatever has happened already is not enough to bring us down out of this red area. And the mass index, we have waiting to see if anything's going to be generated here. There are 3 criteria that need to be met for this indicator. Number 1 is we cross above the red dash line. Number 2 is we go above the blue line. Number 3 will be when we come back down and cross below the red dash line again. And this is trying to signal a reversal. The staples to tech ratio still tending to go down overall. I think, didn't I show that one earlier? So we're a little bit more positive, but we're keeping an eye on that one. We're also watching the interplay between cash and bonds right now. This had been going up because interest rates were going up and inflation fears were going up. Well, this week, this started to come back down, but it's still in a longer term uptrend. We're also looking at tips. Treasury inflation protected securities, they really went up earlier on because interest rates and inflation were going up. And we started to really come down. Haven't really been impacted all that much here by this latest inflation scare. So this is actually looking a little bit better. But we want to look at it in the context of other charts. So this is tips to 3 to 7 year bonds. This is tips to 7 to 10 year bonds, where we are a little bit more concerned here, but we have been pulling back lately. We'll see if that can continue to fall. That would be more positive for stocks. We're also keeping an eye on the Japanese 10-year yield because when we got above 1% last summer, that's what caused the end of the world day. We fell back. Now we're well above 1% now, and we're going to see, is that going to mean something? It'll probably start in Japan again. And if this really starts to treat things more negative in Japan, they own a lot of US bonds. They may have to start selling those bonds. And if they sell those bonds, that's going to push interest rates back up. So that's why we're watching this red area right now, the red line. And we're keeping an eye on the S&P to utilities ratio. Been really choppy, not real convicted lately. When this is going up, the S&P is outperforming. When this is going down, the utilities are outperforming. Oil, just keeping an eye on that. It's still in a downtrend, but it's stuck right around this 70 level, and now it's starting to bounce back up again. Not sure if that's geopolitical or if there's something technical or fundamental that's actually going on with oil going up. High leverage loans. This is what I use as a proxy of the overall economy. One thing I watch is copper. That tends to, if it's going up, that means they're projecting a good economy going forward. Another one is high leverage loans. These are very risky and not even coming down to its 50-day moving average. So according to this chart, things are still looking good economically. Want to keep an eye on the dollar. It's been stronger. That can pressure stocks. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I do post or check out the program that I have. There's a link below this video that will take you to that. Have a great weekend, and I will talk to you in the next video.